Hi. Recently, I had an experience of interviewing candidates for one of the mutual fund company called Meta Earth. So, while interviewing the candidates from the commerce background and in the maths background, uh, the question was asked around the basics of mutual funds, since most of the candidates had either just 1 year of experience or they were just out of the college um, after doing their bachelor's or master's. So the questions asked were like to tell them about the mutual fund, to tell them about the indices and uh, the role of these financial products, and most of it was uh, a basic training that was requested by the candidates. So one suggestion upfront that I gave was to brief them or about the types of funds or about the uh, types of investors. That was upfront. I was briefing them on the interview calls, and then why uh, why there are mutual funds, exchanges, and the difference between a mutual fund and index index fund. So that was something that needs that needs to be researched from the candidates end mostly, though the onus is also on the company to familiarize or share share a minimal amount of information around around the say the reason for creation of these funds, how they operate, and how to how to identify and track investable fund. So here in this video, I am just trying to clarify these uh, these terms that I used today, and as well to create a understanding for for candidates who don't have the basic exposure to the markets, to the various financial instruments that those are created. So I'll base this video on the Meta Earth mobile application, for which the hiring is going on. In one of my recent LinkedIn posts also, one would have seen the job openings and hiring that is going on. So if you log into the Meta Earth website, uh, after successful login, successful registration, you will come across the various categories. uh, First thing is fund search, mutual fund comparison, fund house snapshot, category returns, NFO corners, news update, obviously, and AMC, like asset management corporation category, what is the category of those, and schemes. So I'll start with the first thing that I had asked was mutual difference between the mutual fund and the index fund to a candidate. So basically, a mutual fund is a managed fund, and it is risk averse. Almost the company that is creating the fund and the investors both are almost at the equal risk. It is actively managed and hence has a fees, whereas the indexed fund, it's passively managed. It is very diversified. uh, it acts according to the index to which it is benchmarked, or it is tied to, or correlated to. So there is a difference of management as well as the fees structure. Since index fund is passively managed, the fees is low for the indexed fund. Then there were like the mathematical portion of it, like how the uh, mutual funds are created, or these funds are created. So index funds is uh, like simplified, it's basically like correlated to the index. Almost all the categories of the market is replicated in index fund, and there is slight more trust, though it is 100% dependent on the index. Whereas the mutual fund is tied to the uh, exchange, and it is managed by the fund manager. So the categories of mutual fund that I would be discussing is actively managed on daily basis, or frequently by the market experts who have expertise, experience in trades, and are most updated about the market factors, market news. So uh, in India, the mutual funds majorly are um, are related to the bank, are created by the banks. Uh, so there are 50 around mutual funds, and few of these mutual funds have been around from many years. Like it has been around uh, many years, and hence those are the mutual funds that doesn't need lots of marketing and is easily trusted by the investors. But I'll for the convenience list down all the mutual funds, so that with me it's easier for the candidates also to remember. So we will start with the in the alphabetical order, and the site also is in alphabetical order. So the various mutual funds are Axis Bank, Aditya Birla Sun Life Insurance, then BNP Paribas, that is of Baroda Bank, uh, then uh, is okay, I'll come to the next one later. The BNP Paribas Baroda Bank and Bank of India. Yes, Bank of India Mutual Fund, uh, Canara Bank Mutual Fund, uh, DSP Mutual Fund, Edelweiss Mutual Fund, uh, uh, then uh, uh, Franklinton Mutual Fund, and uh, then Grows Mutual Fund. It's recently been introduced. Then HSBC, HDFC, many of these mutual funds. The uh, uh, ICICI, IDFC mutual fund, ILNFS mutual fund, um, then JLM or JKM mutual fund, uh, Kotak Mahindra mutual fund, with LIC is there. Mahindra mutual fund, Kotak Mahindra I have already Motilal Oswal mutual fund, Mahindra is there. Motilal. Oh, with O there is one of the okay, it was one of the Old Bridge Mutual Fund. Old Bridge Mutual Fund. This name I mostly miss out, but Old Bridge Mutual Fund. S is SBI. S is Sumanco, that is Sumanco Mutual Fund, Shriram Mutual Fund. So with Q, it was QST. I missed Q also. Q is basically Quant and Quantum Mutual Fund, and with T, it's basically Taurus, and W is White Oak, Z is Zerodha. So these are basically the AMC asset management company, which are having the funds from various investors, and they are promising to refund like maximum return competitive to the market rate, and competitive to the various other AMCs that I listed in the alphabetical order, against a management fees. So these AMCs are like composed of, or is a composition of debt and equity, and commodities, and it is a composition of it can be hybrid as well. So one of the candidate had asked me today, like what is meant by debt, what is bond, so, and how is it different to equity, and there was some basics that was asked. So a debt security, as I explained to him, it's a trading security. It's a financial instrument basically, unlike a consumer loan that one avails, that is not openly traded. But a bond is by its nature a tradable security. It has an index mostly if it's registered, and loans, the personal loans, it is also like securitized, and it can also be traded, but it has additional steps. A bond is directly done through a financial instrument, and it is it is openly traded. So in a mutual fund, when the fund manager designed their portfolios, they keep a mix of debt and equity. Equities is like investment directly into the companies in for exchange of dividends, for profit sharing. So it's into the it's in exchange for the share, which is again a financial instrument. So bond becomes a financial instrument, debt becomes a equity becomes a financial instrument, and these are readily traded on the exchanges. Now the composition here is for the aggressive kind of investor, or for a growth mutual fund. The composition is mostly like 90s to 10. 90 is mostly in the high risk, highly volatile growth stocks, which gives very good return. So, and 10% would be debt to just reduce the risk factor. So mostly it's 80 to 20 or 90 to 10 ratios that is maintained in the portfolio. And growth for aggressive or growth mutual funds, mostly volatile and high growth mutual funds are high growth stocks, equity stocks are targeted. Now when we say high growth and volatile equity stocks, one would ask, like, what does it mean by volatile? What is a growth stock? So basically, if one checks on the platform, there the stats would answer that straightforwardly. Like, a volatile stock is one where the sigma is like above like the sigma or the standard deviation, it's really high. It could also sometimes be in double digit, or it could be like 5%, 6%. 5-6% is still subtle. Like it is said the beta is the volatility in comparison to the indices or index where the stocks are trading. So it's basically the benchmark index or indices. So there the beta mostly for a volatile portfolio is more than 1 or more than 2. Mostly for growth stock, it's more than 2. For a very stable stock, the beta is generally 1. Now we are saying beta, we are saying standard deviation. So I also happen to ask for this formula of standard deviation, the formula for beta, from the candidates, and specifically from the candidates who had a BSc in maths. So only out of like so many candidates, only one was like near to the answer, almost right answer. So a standard deviation is again a volatility factor of the stock, like how over the years the stock has performed. So in growth stock, like say volatility of the or standard deviation of the stock is high. So standard deviation formula is the difference of the data point from its mean times the square by n minus 1. N here is the count of the stocks, and whole of this square rooted gives us the standard deviation measure. And if it's in mostly in double digit, then it is considered to be a volatile. There are other stats besides beta and standard deviation, and of course the beta is the covariance by variance factor. Basically, again, like said, beta is calculated by comparing the volatility of the stock to the volatility in the benchmark or the index or indices by the variance, that is covariance by the variance formula, and it gives the beta. And there are beta calculation. If the risk-free rate and the risk premium are known, beta can be also calculated. But beta is more of the market or the it's more of a market factor, whereas the standard deviation is the individual stock's performance. Now there is another stat that could be checked, that is Sharpe ratio. A Sharpe ratio is again individual stocks performance, that is mu minus mu r by the standard deviation. So when we say Sharpe ratio, the Sharpe ratio is like that is the expected return minus the benchmarks or the risk-free rate divided by the standard deviation. So first we covered the standard deviation, that was the logic, and beta was again the market, which touches upon the risk-free rate, and then the standard the Sharpe ratio, which further combines the market to the individual stock and to the volatility. So it is the return per measure of the risk, a Sharpe ratio. That's what it denotes, like how much returns you are getting for each unit of risk being taken. So that's a Sharpe ratio, and the higher the Sharpe ratio, the better it is, because the stock is earning more returns per unit of risk taken. So Sharpe ratio is also compared against the stocks of similar stocks within the same sector. Now, here I mentioned risk-free rate, which I told, which I could have mentioned also for calculation of beta, but since beta is um, can be statistically calculated by covariance by variance formula. Why and when we say covariance by variance formula is that is again the benchmark index minus times the individual stock divided by the individual stocks variance. So it's a simple formula, but there is indirect way also to calculate it through the risk premium if it's given, and risk-free rate, which I was coming to, is nothing but the T-bonds rate. Since a government bond is considered to be the safest marketable security, safest investment, so it is considered to be risk-free. US T-bond, it trades at around 4%, and Indian government bond, it gives a yield of 7% to 8%. So that's where we get for risk-free rate for the even calculation of Sharpe ratio or the calculation of the beta in a CAPM formula. Now that's another jargon. Capital asset pricing model, which is nothing but the return on the stock is equal to the risk-free rate times beta times the risk premium, and risk premium is return on the market minus the that is market's performance minus the risk-free rate. So how much ever market is giving, and subtract the risk-free rate out of that, and just do the maths calculation, shift the numbers shift the numbers from the return on equity minus the risk-free rate divided by this risk premium would give the beta, because through a simple mathematical tweaking of the formula. So this is the CAPM formula, which is checked for return on equity, but this is not mostly like hidden. It is the factor that is obviously considered to form the portfolio, but the risk-free rate is what the high growth mutual funds try to outbeat or outperform, not just their peer companies or peer groups, but that is the marginal return that every investor should check when a fees is charged, that they are earning a return against that fees over and above the risk-free rate. Otherwise, it's very simple to buy a government bond and just wait for it to do the work and give the money. So if the management fees is being paid by the investor, it has to at minimal give a return above the risk-free rate and over and above the most highest performing mutual fund or a stock. So that's how the designing or the stats are checked. Mostly Sharpe ratio, standard deviation, beta are are key are key stats that are checked in a portfolio and are matched. Now there is something that I mentioned earlier, that a portfolio or a mutual fund is designed with a debt and a equity factor. Now equity, I mentioned, like what are the basic or must to have on the tip of the tongue stats. Similarly in bonds or uh, in debt instruments, uh, there are two stats that one should know: how yield reacts to the price, that is, it's inversely proportional. If yield is if yield goes down, or the interest rate goes down, price goes up. That is a very simple uh, demand and supply formula that is applied. That is, if the cost to the investor um, uh, is or the interest paid to the on the bond is less, the price would automatically or the demand would automatically be high, and hence the price goes up. So the uh, the interest and the price works inversely proportional in bond. And the most used term in bond is duration. Duration is the it's again a long statistical formula to calculate the duration, basically to check the risk on the bond. Basically duration, it's like it said, if there are stocks with this which are priced same, has a different interest rate, it definitely the coupon gets calculated very differently and has different terms. So how the investor should decide like which bond or which debt should be selected for such case where the price is the same, the terms of the bond is different, and the rates are uh, either it could be same or it could also be different. So in such cases, it is said the shorter the bond, then the term, it is more profitable. Like for a 15-year bond, if the duration calculated is less than the term, or is less than the bond which is priced at similar value, the bond that gives the shortest duration should be calculated. Now duration formula is like a bond, say a priced at particular dollar value with uh, with a face value of, say, usually the bonds have $1,000 and has a rate. So it is duration calculates the relationship between the coupon rate to the time factor. So over the years, the interest or the coupon on the bond when discounted and divided by the face value, and this dividend or remainder factor, that is the discounted coupon of each year upon the face value, when this is averaged and subtracted from each of this calculated data value and squared, usually the sum of all of this is gets calculated to 1. That is the check point, that is the check value. And when it is squared and summed up, the value that gets calculated is to be compared to the similar bond with the same price. So this smaller the duration of a bond, the more profitable it is. So duration is one factor that is checked, but we will get back to the duration formula in detail, as it is highly statistical, involves multiple steps, and it would be better to understand through a demo. So coming back to the Meta Earth platform, we touched on the mutual funds. What are the stats that is calculated, and what each of those stat represents. Then the category which we discussed between debt and equity, and there is commodity, obviously precious metal is one such thing, and there is hybrid, and we discussed on the growth. Next comes the value or the dividend mutual fund. What does that mean? The value or a dividend mutual fund is one where the risk factor is very low, the standard deviation would be very low, the volatility would be, the beta will be less than 1. So most of the FMCG stocks, the consumer cyclical stocks, those are less than those are very stable stocks. Those can be passively managed, and hence the investment is meant for the purpose of earning a dividend, earning a return on the profit, or a return on the earnings. So in such cases, price to earning ratio is checked, like how many times the price per share is in terms of the earnings, that is earning per share as well. So the net income, when the earnings are released by the various publicly traded companies, that is the net income. If it's like 1 and the stock is priced at say 100, how can it be a value stock, one might question. But in most of the cases, in high value companies, like any of the mega mag 7 stocks of the world, it is because those companies have proven their market value and have such a high market cap that the earning per share, though would be low, but those are considered to be a value stock, those are considered to be a dividend stock, because over the years, if not immediately when the dividend is announced, those returns on the dividend is quite high. Something that could be checked here for such companies value calculation is Gordon growth model, which is uh, dividend of the second year by dividend of the first year by the by the price that gives the return, that gives the percentage of return. And if dividend of the or I'll get back on the Gordon growth model. Maybe again, it's also like the growth factor is taken into account. That is the dividend of the first year minus the dividend of the last year by times the growth by return minus rate of return minus the growth. So and in numerator it is 1 plus g, that is a dividend of the current year minus dividend of the dividend of the last year times 1 plus g, where g is the growth of such valued companies, by rate of return, that is the dividend payout rate minus the growth expected on such stocks. So the value stocks are like very old aged companies. It is like highly stable stock, there isn't any risk. Example is mostly like high industries. Reliance comes under one one such category. So besides growth, there is this value stock. Now coming back to the uh, coming back to the mutual fund category, like we discussed about the value stock, growth stock, debt, equity, commodity, the stats that has to be checked, the way those are calculated. Then the various kinds of AMCs that have mutual funds. What to remember? Next is there are mutual funds. Those are calculated. Those are calculated also for also for the market cap. Now when we say market cap, what it means is the market cap could be the size of the company, that is it's totally the equity factor that is considered. So the equity capital, that is the shareholders capital in the company, is say above 225 crores. It is considered as a mega cap. And between 75 crore to 225 crore it comes as a large cap, and 75 crore to below to up to 25 crore it is considered as a mid cap, and below 25 crore it is like small cap. So there is a categorization on the size of equity, that is the funds from the market investors, which defines the market cap, and that is also one of the factor or the criteria to create mutual fund, whether the mutual fund is invested for or is created out of the mid cap and large cap stocks, or it is created out of mega cap stocks. Usually the mid cap stocks, one of the alphabet mutual fund which I missed to mention was Nippon. Nippon is having a large cap mutual fund, which means that it is highly stable mutual fund, and any passive investor should have a uh, investment or a or a or a selection for Nippon category. So this is also one of the criterias for creating or forming the mutual funds. Then again, mutual fund comparison, as has been said, it is for various banks, Helios, HSBC, HDFC, ICICI, Invesco, ITI, all those. Then category is this one. Fund house is snapshot. Fund house is debt, equity, and others. And category is again focused funds, which would be on searching for the alpha stock. Again, alpha stock, there is a Pharma French model that helps to search the search the alpha stocks, and it's again a formula like something which is like low at risk and high on returns. So obviously those are alpha stocks. And then okay, what SIP, one of the candidate was able to answer to the SIP, which was a short installment plan, and that was great of the candidate to know the jargon, know the term. I'm just quickly recollecting the other candidates' doubt and other candidates' questions. So another this one was another search criteria was the search criteria was the was okay. Another question that I asked was how much they understand financial statement, what are the components of financial statement. So it is basically the balance sheet, the profit and loss, and trial balance, and the cash flow statement. So today one of the candidate did break down the components of the financial statement, and it is basically the 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 uh, uh, composition of the price to earning ratio, that could be easily understood. Um how much is being spent on the R&D, that dictates whether uh, it's a right fit to select such a company's stock for creation of dividend portfolio. So dividend is released by value companies such as the Mag 7 or the high, large and mega cap companies of India. Dividends are released, but if the horizon or the term of the investment is say 5 years, and the investor is selecting uh, a stock which is going to release dividend only after 7 years, it would be not worth investing in such a value portfolio or a dividend mutual fund or value mutual fund, as the investor wouldn't be able to earn a dividend on it, and it would be low performing value mutual fund. So there are certain criteria, certain market moves that should be checked before the investment, like companies retain the return on the stocks, that is dividend, for R&D reasons. And these days, given the automation drive, the um, technology upgrade that is going on, the companies do retain the profits, and don't release and uh, earnings, or don't release a dividend and hold back the dividend. So including those on the dividend mutual fund for long time, uh, um, or in a in a horizon that won't fetch the investor money, should be checked. This should be asked by the investor for the composition of companies in a mutual fund. Like if there are companies that are uh, being called out in the market for not releasing dividend, holding back the dividend for R&D reasons, such such should be checked with the individual's uh, goal needs, financial needs. Uh, these are some of the checks. Now, compared to the a very basic stat that I said, like it's very obvious for clients to check at first hand. Like it is like any investment, how much return would I get? So usually the market competitive rate for most of the mutual fund is around 20 to 30%, and recently the market has performed really, uh, I mean it's 20 to 50%, then only it makes sense to invest in mutual fund, to pay a fees to a to actively support the uh, profile, to actively support the mutual fund. It would make sense. So if one goes to the category returns, like everyone checks for 20 to 50% of return on their investment. So the nature of or the category of investments are also given, uh, and the returns, on an average the returns that is generated. So usually the horizon for mutual funds is minimum locking period is 3% for the stability, but in 1% the maximum, if one sees the maximum return that is given is by mid cap. Yeah, and this I skipped. What is the logic behind the market cap or the equity size of the companies? Obviously, usually a mid size company are in the growth trajectory and have high return. So any mid cap equity fund, equity mutual fund, it's always gives a good return. And like said, large cap, mega cap funds, usually large cap, they tend to retain the dividend, and hence the uh, specifically where the market is centered and there is lots of competition, like there is AI spree that is going on, and hence any company which is AI based or is heavily technology based, even the EV ones, the semiconductors, so they are currently investing heavily on the R&D. If the profit and loss for such statement is checked, the R&D costs are really high. So those are some stats that is checked, and are are a key catch that large cap stocks of technology in current market scenario is not good to invest in if the expectation is to earn high return. Also on one side, just a bit of information, commodities such as precious metal are uh, considered to be safe investment, are inflation free, are recession free stocks. So the technology stocks are also considered to be risk averse stocks, so they are immune to inflation. uh, that was a recent uh, I mean modern post .com bubble or .com crisis, an observation made that technology is just becomes so dependent that uh, the that the inflation is not depreciating the value of the company. It's not depreciating the returns. So in when there is an inflation, buy Google stock, buy the very heavy technology stocks. Nvidia is heavily now invested in R&D and has come up with some terabyte chip that can do the compute really competitively, and hence the AI products, all the AI based companies can have the best graphics, and can have the best um, compute. um, so these are basically an inflation savvy stocks. Now EV, we already can relate it to the semiconductors. Then quickly checking, there is futures and options which is high at risk. It is said that 9 out of 10 suffered losses. So futures and options are derivatives, and it suffers loss. Uh, so any risk averse person should be investing in a sectoral fund. Sectoral is sector specific, like seafood. Okay, any risk averse person shouldn't be investing in uh, in a volatile in a very volatile stock. So yeah, I hope most of the criterias, jargons is covered in the session, and hope to increase the productivity and get familiarized with the various kinds of funds. Try to understand the client's need and walk them through the fund category, uh, the FNO for the mutual funds, the funds of funds, new fund options, uh, precious metals, and any first time investor or the risk averse investors should be paid attention to, and should be informed thoroughly about the market risks, and not to invest in the small cap companies. Uh, so all the best, and keep yourself updated with the various financial products.